and the public hasn't caught on yet. So I think, unlike the prior peaks of 2000, I don't expect any significant pullback from the current $3,000 price. In fact, we're probably going to go straight up to 4,000 and beyond. And in fact, when gold hit 2,000 in 2020, in April of 2020, the dollar index was at 93. Today, the dollar index is at 103. So the dollar has increased 10%, even as gold prices have risen 50% in dollar before the end of the year. In fact, I think it'll go lower. But when the dollar index hits 93 next time, I expect gold to be pretty close to $3,500 an ounce, not 3,000.
Gold prices are expected to rise significantly without major pullbacks, surpassing $4,000. Despite the dollar index increasing from 93 to 103 since 2020, gold has gained 50% in dollar terms and even more in other currencies. The dollar will likely decline, with the index expected to drop to 93 or lower by year-end. When that happens, gold could reach around $3,500 an ounce. PeterSchiff, a well-known economist, financial commentator, and investor, explains that gold has surged past $3,000 an ounce, yet media coverage and public interest remain low. Unlike previous peaks in 2011 and 2020, investors have sold gold even as prices climbed from $2,000 to $3,000. This suggests a strong and sustained bull market, with central banks being the primary buyers. Gold has already outperformed the S&P 500, and its upward momentum is expected to accelerate. Meanwhile, central banks, the insiders of the fiat monetary system, are shifting from dollars to gold, signaling more profound financial shifts. Unlike speculative retail investors, these institutions are making long-term strategic moves. Historically, insider buying in markets indicates confidence, and this trend suggests gold's rally is far from over. Watch the full video for more insights. If you found this valuable, please like and subscribe for the latest updates.
Probably was, at the end of the first quarter. And then it never looked back. The price of gold kept going up until today. It's now above $3,000 an ounce. But again, today, no real media coverage. It's barely been mentioned. Nobody is talking about it. Not like they talked about it at 2000 in 2020 or when it almost got to 2000 in 2011. It wasn't even an afterthought or a second thought. Nobody is paying attention. The public has been selling gold the entire rise from 2000 to 3,000. So to me, this looks very different than 2011 and 2020. We've built an enormous base for gold at 2,000. This is a brand new leg of a huge bull market where gold started below 300. We've now gone up 10x in the price of gold so far this century. Gold is beating the S&P 500, and I think it's going to accelerate from here and even take a bigger lead on the stock market as the stock market goes down, but it's doing it in complete obscurity. There is no gold rush going on. Investors haven't woken up. In fact, all of the buying really is being driven by the central bankers. Investors haven't even woken up to what central banks are doing, but the central bankers are the insiders of the fiat monetary system. So when you see in the stock market, if the insiders, the people that work at the company, are buying company stock, that's a good sign. If they're selling company stock, then maybe they know something bad and you should follow their lead. Well, the insiders in the fiat monetary system have been dumping their dollars to buy gold. They obviously know something, and the public hasn't caught on yet. So I think, unlike the prior peaks of 2000, I don't expect any significant pullback from the current $3,000 price. In fact, we're probably going to go straight up to 4,000 and beyond. And in fact, when gold hit 2020, in April of 2020, the dollar index was at 93. Today, the dollar index is at 103. So the dollar has increased 10%, even as gold prices have risen 50% in dollars. And what that means is that the price of gold in other currencies, like the euro, like the pound, like the Australian or Canadian dollar or the Japanese yen or a lot of other currencies, gold has done even better in terms of those currencies than it has in terms of the dollar. But my expectation is that the dollar has topped and is headed substantially lower. I expect the dollar index to get down to 93 again.
PeterSchiff highlights that silver remains undervalued compared to gold, below $34 an ounce. Unlike gold, central banks aren't buying silver, making it more dependent on retail investors, who have yet to seize its potential. With past peaks at $50 in 1980 and 2011, silver is likely to break that level soon, and once it does, it could surge higher. Buying silver now could be a great opportunity before prices take off. For those seeking higher returns, gold mining stocks present an attractive option. PeterSchiff mentions that despite gold's 50% rise, mining stocks remain lower than gold at $2,000 in 2020. These stocks represent ownership in gold reserves still in the ground, and while rising mining costs have hurt valuations, the recent surge in gold prices is outpacing those costs. As inflation remains high and gold prices continue to rise, mining companies stand to benefit significantly. PeterSchiff clarified that many investors still believe inflation will return to 2%, but that's unlikely. Inflation has bottomed out and is headed higher, which has not yet been fully priced into gold. Over the coming months and years, gold is expected to rise faster than mining costs, making gold stocks a valuable long-term investment. Those looking for more significant gains should consider mining stocks, as they have yet to reflect gold's bullish trend. Now let's shift our attention towards the interview.
Instead of buying gold, which you could buy, and I still recommend because it's going up, you could buy silver, because silver is still below $34 an ounce. The reason that silver has not gone along for the ride with gold is because central banks aren't buying silver. That's what retail investors buy. Silver has been described as the poor man's gold. Well, men and women haven't been buying gold or silver unless they're central bankers. So silver is the sleeper precious metal that's about to wake up. Silver doubled top at 50 in 2011. It didn't even get back to 50 in 2020. It got to about 35. We're almost there now, but still not quite. I mean, gold has gone up by 50% and the price of silver has gone down. That's really unprecedented. The other time silver hit $50 was 1980 when the Hunt brothers tried to corner the market. I think we're going to see $50 silver probably this year. And I think when it breaks $50, it's going to be like gold breaking 2000. It's going to go up really and not look back. So if you missed the boat on gold, although it's not really missed because I think it's going a lot higher, but if you miss buying $2,000 gold, you don't want to miss buying sub $34 silver or even sub 50 because you won't be able to get those prices for long. And at Schiff Gold, it's that we got gold in the name, but we still sell silver. So you can call up Schiff Gold and order some silver. And then you know what? When silver really makes a move, maybe you can trade out of some of your silver and get a little bit more gold. But if you really want to go for the home run, you want to look at the mining stocks. I don't really talk too much about them on these Schiff Gold videos, but I can't help it because the mining stocks, I think right now, are the best way to buy gold if you've got more of a higher risk tolerance. You know, the gold stocks are lower today than they were when gold closed at 2000 in April of 2020. So again, you've had a 50% rise in the price of gold, yet gold stocks that mine that gold and have huge reserves of that gold have actually gone down. You know, when you buy gold from Schiff Gold, you're buying above ground gold. It's already been mined and refined, right, and turned into a coin or a bar, and we ship it to your house. But when you buy stock in a gold mining company, you're still buying gold. You're just buying gold that's still in the ground. You're buying the reserves of the company because you become part owner of a gold company when you buy stock in the company. And the assets of the company are the gold reserves. Now, the business is to mine those reserves and sell them, right? And then earn cash that it can distribute to the stockholders. But it's a way of buying gold. Now, the reason gold in the ground has not done as well as gold above ground has to do with the rising costs of mining. But recently, the price of gold has been rising faster than the cost of mining it. That hasn't been true because inflation has driven up mining costs faster than it's driven up the price of gold, because there's been so much skepticism on the part of investors that keep thinking the price of gold is going to fall. Investors haven't woken up to the reality of high inflation as far as the eye can see. They still believe that the Fed is going to be able to bring inflation back down to 2%. There's no chance that's going to happen. Inflation isn't going anywhere near that. In fact, it's already bottomed out and is headed much higher. None of that has really been priced into gold yet, but I expect that over the next several months and several years, gold prices are going to rise much faster than the cost of mining. And so that's going to make mining a much more valuable business, but also it's going to really unlock the value of the gold that's still in the ground.
Gold and silver markets are positioned for significant growth, with central banks driving gold's rally and silver poised to catch up. Mining stocks offer an additional opportunity for investors seeking higher returns, as they remain undervalued despite rising gold prices. With inflation expected to stay high, the long-term outlook for precious metals remains strong. Do you think retail investors will start buying silver once it breaks $50, similar to gold's past rallies? How might a declining dollar impact gold and silver prices in the next year? Share your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for being part of our journey.